All right, let's get right into it. Today, we're taking on one of the biggest financial decisions you'll ever make. We're going to run a full-on audit of the American dream of homeownership and really question a piece of advice that you've probably heard your entire life.
You know the line, right? Renting is just throwing money away. We've all heard it. It's like the golden rule of personal finance, presented as this absolute, unshakable truth. But what if? What if that truth is built on a calculation that conveniently leaves out some of the biggest numbers? So, let's just start with a number that'll stop you in your tracks, negative 1.4%. In a recent year, that was the actual inflation-adjusted return on home ownership. That means the house, your big asset, it actually lost purchasing power. And get this, that's before you even factor in the thousands and thousands of dollars you have to spend just to keep it from falling down.
Look, just to be clear, this isn't about feelings or opinions. We're coming at this like engineers. Think of this as a systematic audit. We're looking at the numbers, the hidden costs, and yeah, even the weird psychological biases behind what is, for most people, the single biggest purchase they will ever make.
Okay, Section 1, the price of entry. You know, before you've even paid $1 towards your actual mortgage, you have to pay this giant fee just to get in the door. It's a cost almost everyone underestimates. Let's call it the transaction toll.
And here's the thing, the system gets you coming and going. When you buy the house, you get hit with up to 5% of the price in closing costs. Then, when you eventually sell it, you pay another 5 to 6% in realtor commissions and other fees. This is a huge, immediate loss of your money right from the very start.
Let's make that real. On a pretty typical $400,000 home, you could be looking at a total transaction cost of up to $44,000. Just think about that for a second. That's money that just evaporates. It doesn't build your equity, it's not earning you a return, it's just the price of admission.
So here's the bottom line on that. Because of those massive upfront costs, your house has to appreciate by a pretty significant amount just for you to get back to zero. This is exactly why, if you think you might move in less than, say, 3 to 5 years, you've almost certainly lost money on the whole deal.
All right, Section 2, the hidden costs of ownership. So you've paid the entry fee, you're in. But the costs don't stop. Now you have this relentless financial bleed from hidden operating expenses. Honestly, the best way to think about it is as a mandatory and very, very expensive subscription fee for owning your home.
Yeah, this is the number that those online mortgage calculators always seem to forget. The national average for these costs, we're talking everything but the mortgage, is nearly $16,000 a year. A huge chunk of that is maintenance, you know, a new roof, a busted furnace, but property taxes and homeowners insurance, which is getting crazy expensive, are also massive factors.
Now, let's zoom out. What does that look like over the life of a typical 30-year loan? Well, those so-called hidden costs can add up to almost $750,000. I mean, come on, that isn't building wealth. That's just money you are constantly paying out just to prevent the giant asset you bought from falling apart. And hey, don't just take my word for it. This isn't some fringe theory. This is the real lived experience for the vast majority of homeowners. A staggering 81% of them say their costs ended up being way higher than they expected. That's not a coincidence. That tells you the system itself is kind of designed to hide the true price tag.
Okay, Section 3. Let's talk about your brain on real estate. The numbers we've looked at are pretty stark, right? So why is it so hard for us to accept them? Well, the answer isn't in a spreadsheet. It's inside our own heads. Let's dive into the cognitive glitches that make it so hard to be objective about this decision.
First up, there's something called the endowment effect. It's fascinating. Neuroimaging studies literally show that once you decide you own something, a specific part of your brain, the loss aversion center, it just lights up. The thought of ever giving it up starts to feel like a real loss. This isn't a character flaw, it's just biology. Your brain starts defending the purchase before you've even finished the math.
And that gets piled on with another one called status quo bias. We're just fundamentally wired to prefer things to stay the same. So you combine that bias with all the money you've already sunk into the house, and it creates this powerful psychological lock. It can stop you from ever honestly reevaluating whether it was a good decision down the road.
And of course, our biases are supercharged by what's happened recently. If you look at this timeline, you see the bubble, the crash, but that period from 2012 to 2021, that is what really created the modern myth that real estate always goes up. It was a 9-year anomaly, a total historical fluke of basically free money. Well, that era is over. We're now in a market that looks a whole lot more like the rest of history, where returns are often flat and the costs are painfully high.
Okay, Section 4. Now we get to the heart of this whole audit. Let's strip away all the emotion, all the bias, and just run a head-to-head simulation. We're going to compare the pure wealth-building potential of a homeowner versus a disciplined renter.
So let's start with the down payment. We'll say it's $87,000, about 20% on a median-priced home. The homeowner, they immediately lock that cash into a single illiquid asset. It's tied up. The disciplined renter, in our scenario, takes that exact same $87,000 and invests it into a diversified liquid stock portfolio.
And here is the incredible power of that one simple decision. At a pretty conservative 7% real return, which is the historical average for the S&P 500, that renter's initial investment doubles in 10 years and nearly quadruples in 20. And that is pure liquid wealth. It's generated from the very same capital that the homeowner locked away in their house.
And the reason for that huge difference is really fundamental. A house is not just an asset. It's something you use and wear out every single day. And that comes with costs and depreciation. And that reality is baked into the long-term data. If you look at over 130 years of data from Nobel laureate Robert Shiller, the real inflation-adjusted return on U.S. real estate is just 0.7% a year. The stock market's historical return is 10 times higher. This right here, this is the core mathematical truth that the whole real estate always wins story just completely ignores.
But wait a second. I know what you're thinking. What about this chart? This is the big counter-argument you always hear, right? Federal Reserve data shows the median homeowner is like 40 times wealthier than the median renter. So, case closed. Homeownership wins, right?
Well, not so fast. This is where we have to be really careful. The key is understanding why that gap exists. It is a textbook example of something called selection bias. Here's the deal. Homeowners don't magically become wealthy because they buy a home. They're able to buy a home in the first place because they are already wealthier, older, and more financially stable. The statistic isn't comparing apples to apples. It's comparing two totally different groups of people from the start.
Which brings us to Section 5, the verdict. So after all this, does it mean you should never, ever buy a house? No, absolutely not. What it means is you have to be incredibly strategic about it. So let's turn all this into an actionable framework, a 5-point checklist for when buying can actually be the winning financial move.
You should only really be thinking about buying if you can honestly check all 5 of these boxes. Number 1, you plan to stay put for at least 7 to 10 years. You need that time to overcome those crazy transaction costs. 2, the price-to-rent ratio in your area is low, ideally below 20. 3, your total all-in monthly cost of owning is going to be pretty similar to what you'd pay in rent anyway. 4, you have deep cash reserves for all the stuff that's inevitably going to break. And 5, you have the financial discipline not to treat your home equity like a personal ATM. If even one of these is a no, the math very quickly starts to work against you.
And really, that's what this all boils down to. Look, the emotional pull to own a home is real, it's powerful. But that house, it's not going anywhere. You have time to just pause, to ignore all the pressure from everyone, and to actually run the numbers for yourself. The question isn't just, can I afford this house? The real engineering level question you need to ask yourself is, do the numbers, my numbers, truly support buying it?